Michael, what do you think? Is this a time to be selling, or was yesterday's sell-off a little bit of a buying opportunity?
I think we're close to a time to be buying.
Not there yet.
There's probably a little more room to go. You have some headwinds that are building up, especially in the internet sector with, things like political pressure. We're heading into an election cycle. That's usually a tailwind, but it could be a headwind until, some of the regulatory scrutiny stops. But overall, we don't want to be too defensive and avoid this sector too much because when the market comes back, like there's real growth here, and
what about valuations overall?
Yeah, overall valuations are reasonable, and we are advising folks to be a little more focused on some of the more reasonably valued stocks like Google and Facebook. Two stocks that don't really have a lot of valuation support, but we think are going to be the new leadership as we pull out of this are Lyft and Uber. The tech sell-off sort of coincides with those IPOs, and we think there's a lot of fundamental upside there.
All right, we're going to come back to that, but Brent, let's get your thoughts broadly too. You like technology, particularly the internet stocks right now, or not?
We like the valuation. You look at Facebook, it's 17 times next year's earnings, $10 a share. So you're getting to a point where valuation is pretty reasonable. Everyone left internet because of the regulatory headlines. They crowded it into software, and now you're seeing a software sell-off because the valuations went to a point of no return in some of these names. So I think effectively the internet group has underperformed the NASDAQ. It's underperformed the broader software group as you look at the rest of tech. So as Michael said, I think some of the valuations, Google at 10 times EBITDA, they'll grow EBITDA mid-teens. Facebook 17 times now on next year's earnings number. It looks more reasonable. Tactically, I think investors are in defense mode, and they don't want to touch the group until we get to earnings. So I think we're in a little bit of a short-term vacuum where right now we have a lot of clients that had a tough last month, and they're not ready to go back onto offense yet. So, long-term, yes. Tactically, I think there's a short-term pause.
You don't worry about the regulatory overhang, particularly in a stock like Facebook?
We do, absolutely. But as I've been saying, this regulatory overhang has been in these stocks for the last year. If you look at Google, just the last few weeks, even with all the new regulatory overhang, Google's stock has actually held flat. It's up maybe a little. The rest of the group has come off hard. So we're off about 14% on FANG from the top. Google has been hit less hard because of it was already embedded in the stock. So I think a lot of the regulatory overhang is there, and I think that's now kind of baked into a lot of these stories.
Michael, why do you like Uber and Lyft?
I think that they are building great big businesses that are going to, grow for a long time. When you look at Uber's Uber Works announcement this morning, where they're having a gig worker, job finding app that folks like who are already drivers, but other workers can use to find work. They're taking a platform that they've built and leveraging it into a lot of new businesses, which sounds a lot like Amazon. It sounds a lot like Google.
Right, but then you think about a situation like WeWork where they expanded too fast, too quickly into too many different businesses. How do you come down on the line of trying to come to a profit before you're able to do some of those things, or go ahead and just keep trying to grow? Well,
both stocks are down, 35 to 45% from their IPOs. It reminds me a lot of Facebook's IPO. In 5 or 6 months after Facebook went public, it was trading at $18, $19 a share. It's up 900% since then.
Was Facebook profitable at that point?
It was profitable, and that's a
big difference.
The piece that I don't get about this.
Well, we've seen with Amazon that over time, the public investors are willing for good management teams in good strategic positions to underwrite.
But can I ask you a separate question?
Yeah.
And I think there's a vast I think that there's an Amazon myth out there, and all these companies want to say, I'm Amazon, I'm Amazon, I'm Amazon. But guess what? Amazon raised money once in the IPO. That was the end of it. There wasn't like multiple things that had to happen later. There wasn't endless red. They were able to finance themselves. So you tell me how this looks like Amazon. I'm not telling you Uber or Lyft are bad businesses, but I also don't think that they're comparable. I've never understood that comparison.
Well, they're not comparable now because they're just getting started.
Let's look at a calendar. Do you remember when they started? Because this is not just getting started. This is not like a couple years out here.
They are fully funded. Like, they're not going to need to raise more money
ever again,
unless they want to. But it's not going to be a need, right? They have enough cash socked away to get them through this investment period. And you've just got dramatic growth in that sector, and I think the sector is going to get a lot bigger. I mean, I don't know one person who's using Lyft and Uber less than they were before.